Tito's Handmade Vodka is America's favorite vodka for a reason. From the first legal distillery in Texas, Tito's is 6 times distilled till it's just right. And naturally gluten-free, making it a high-quality spirit that mixes with just about anything. From the smoothest martinis to the best Bloody Marys. Tito's is known for giving back, teaming up with nonprofits to serve its communities and do good for dogs. Make your next cocktail with Tito's. Distilled and bottled by 5th Generation Inc., Austin, Texas. 40% alcohol by volume. Savor responsibly.
Reality radio for a really great future. We're talking real money.
Oh, no, it's not that time of year again, is it? Yes, it is. Once again, ladies and gentlemen, it's the one time during a otherwise good stock year, when you won't like those high returns you got in some of these funds, particularly if you're using actively managed funds. Hello, everyone. Don McDonald here for another, exciting edition of the Talking Real Money podcast, along with the inimitable brown shirt Tom Cock, hanging out in Belluvian, Washington.
Yeah.
Belluvian?
That's close enough. I've never owned a shirt of this color.
This ilk?
What do you think?
It's very brown.
Yeah, it is very brown. So
very brown.
Like
but of course, you're all dapper. I, on the other hand, am in a long-sleeve T-shirt because
it's in the 30s.
Flipping cold in Florida now.
Wow. Yeah, that was crazy to see that you went from like the 80s to the 30s in 24 hours.
Oh, it was just, I was so cold. I was cold. I was cold to the bones. I could not warm up.
Okay.
I was going to start a fire, but I don't have a fireplace, and I figured it wouldn't be good for the house to just start a random indoor fire.
Yeah, that's bad.
Welcome to the program. It is coming up on capital gains time of the year. That's what happens in December, which is where we are right now. Oh, my gosh, it's already December.
It's the
Time flies when you get old, doesn't it?
It does.
Don't sing.
I know.
Stop it.
You're the only guy allowed to sing. If it was you, be all over it. Me,
no,
not so
I'm
much.
not. Do you hear me singing? Because I'm very depressed because my exciting Royce Midcap.
It actually is Midcap.
I love the name of this fund.
Yeah.
The Royce Midcap Total Return Fund. Oh, very creative
why we're talking
name.
about. Why are we talking about
Why
Royce?
are we talking about it? Because Morningstar just recently published a piece on the big capital gains distributions coming from a number of mutual funds. Mutual funds. This is one of the advantages to owning ETFs, folks. Generally speaking, they don't distribute capital gains. They don't have to, but mutual funds, if they sell a security at a profit during the course of the year, they're required to distribute most of that gain to you, the shareholder, and then you, the shareholder, if it's not in an IRA or 401k or other tax-advantaged account, have to pay taxes, even though you didn't actually get the money. Even if you're reinvesting, you still have to pay taxes.
And then people have a tendency to forget this, but they also have a tendency to forget that your partner in anything you do in a taxable type account is the U.S. government, and it can be expensive. And we're going to show you just how expensive it can be this time.
And here's the thing. This is another great argument against actively managed mutual funds in general. Now, there are some that are more tax efficient than others. For example, I looked at the whole darn list, and generally speaking, Vanguard has very low, even in their active funds, they have very low capital gains distributions because they don't trade a lot.
And what's your number for that? What's low? What does that mean?
Oh, let me go to the Vanguard.
Because this piece that was provided, there were a lot of funds on the list. Now, some of them were more efficient than others. But...
Yeah, Vanguard tends to run in the single digits.
Okay. So it's not horrible.
Yeah, and of the actively managed, the big groups, another one that, like Rowe Price, tends to run in the low to mid single digits, generally
So they're at least
speaking.
thinking about it to some extent, kind of.
They're not trading all the time. The American Funds Group, all of their equity funds are in the single digit range, from 3% to 9% roughly. So they don't trade a lot. But the big capital gains distribution for the year, the biggest, is coming from that Royce Midcap SMID. That's not a word, is it?
No.
Okay, good. Just wanted to check. I thought my vocabulary
Well, there are
was
750,000 words, so it may be that I'm unaware of it.
I mean, okay. I'm doing pretty good with my. I'm getting old, so lately,
pretty well. But anyway,
over the past few months, I've gone back to doing the Wordle.
Oh, that probably helps, doesn't it?
In the New York Times. Yeah, today. Oh, man, I had a tough time today. And I'm also now doing the Apple News crossword puzzles every single day without fail. It's my mental exercise.
Sure. I love it.
And let me tell you, the weekend ones are tough. But I do them anyway. Okay. Royce Midcap Total Return Fund. Would you like to know what its capital gains distribution is likely to be?
I would love to know.
All right, I'm gonna give you the Royce number in a minute. I'm going to hold back a little bit. We talked a little bit earlier about how most funds that distribute capital gains distribute in the single digits. However, Morningstar found that more than 35 funds are going to give out to shareholders more than 10% of their assets as a capital gain. Even though they're not really leaving, you're going to get a capital gain on more than 10% of your assets. Okay? 35 funds. That doesn't sound so terrible. Unless you get into the Royce Midcap Total Return universe. I'm going to give you the number now. As I said,
I'm going to give you the ticker first, RDVIX.
If you're playing along at home.
There you go.
Here we go. If I had a drum roll, I'd play it. Oh, wait. I have a drum roll.
Yeah,
drum roll, please.
Yep.
83% of the value of the portfolio. So if you have $100,000, you are going to pay taxes on $83,000.
And let's talk about why. And by the way, they're not the only one on the list. That just happens to be
but that's the
most
biggest
egregious.
number. Yeah.
Couple things that are pretty interesting about all this. Number one, most of the top 50 funds, the reason is people are getting their money and getting out. They've got big outflows, so they got to sell stuff to create the money to give people, right? So that creates a locked-in gain. And then the other one is, this was surprising, maybe it was not. And you're going to talk about the Royce turnover ratio in just a minute.
Oh, I got a lot of numbers on Royce here.
The top 50 poor performance, 30 of the 50 funds finished in the bottom half of their respective categories over the trailing one-year period. Don't really care about 1 year. 3 years is the same thing, and I bet you go 10, it's even worse. So, I mean, these are funds where people are taking money out and funds where the performance is poor. But back to Royce for just a minute. They're doing everything they can to turn over that portfolio to make you some money, apparently, right?
Well, yeah, and they're not turning it over actually as much as I thought. It's just they must have some big gains on the things they're turning because their turnover ratio is only 62%. So that means about 62% of the portfolio from 1 year to the next changed. Was sold.
Sounds like a lot to me,
purchased.
but okay. Yeah.
But I've seen 100% turnover portfolios. But Royce has all kinds of things going against it. Just all kinds of things. One, it's tiny. It's 46 stocks. That's all. Two, the fund is tiny. I'm not even sure why it exists anymore. It's part of Franklin Templeton now. But it's only a $40 million fund. They should just shut the stupid thing down.
How much are they charging?
Expense ratio, 1.1% per year.
There's your answer, because while everything else is charging, 1/10 of 1%, they're charging 10 times as much.
1.1, and people are apparently still paying it.
Yeah.
And how does this, if in some miraculous way, this fund was just amazing and it was doing so well, maybe it's worth all of that. Maybe it's worth all those taxes and all those fees. Boy, you better hope you have this thing in your IRA if you own it.
I was getting to that, yeah.
Their 15-year average annual return is 3% below the small mid index.
They're annualized?
Annualized. 3% per year on average.
That's quite a bit below. My take is this is one of those funds where people walk in and go, I bought this 20 years ago and I never got around to selling it. What do you think?
It's one of those hodgepodge things that you're going to find in that big portfolio that a broker sold somebody years and years and years ago.
Yeah, but let's talk. So if you really you make a very good point. If you had to own an actively managed fund because you just believe in it for whatever reason, which we don't, then it should be in your qualified accounts, your IRA, your Roth IRA, something like that. If you had to, right?
Right.
Number
if you
two.
Had to. But the funny. Let me just let everyone know. You don't have to. Really, you don't.
Yeah, which brings me to part two. Index funds, which we believe in because we think you should own the market. Maybe you get into little factors or whatever, but index funds are more tax efficient. For the previously stated turnover, if nothing else, right? Because they're not changing 0.6 of the portfolio annually. They hold a lot more stocks than that. So, and again, that helps. ETFs, which you mentioned, really the quote I read from someone who was, this solves many of these problems if you own an exchange-traded fund instead of a mutual fund. And I don't know if Royce probably not has a share class available in ETFs.
Not of that fund, no.
But here's the other thing that people haven't, they get knee-jerk reaction when they look at it and go, oh my gosh, they don't know their tax situation, so what the true impact of this will be before they do something. Oftentimes they hand it to me and go, what should I do? And I say, well, nothing right now. You need to analyze where you are for taxes, figure out if there's a place to offset, all those things before you just race out and sell anything. That's a mistake I see people make all the time. But the biggest one, frankly, is just to own these funds anyway. I mean, these are crazy.
And let's just make a comparison. Let's do a relatively fair comparison. Let's go to a fund with a small value tilt. It's aggressive, like the Royce fund. Avantis All Equity, which is AVGE.
Holds a lot more stocks, of course.
Thousands of stocks. Rather than charging you 1.09, they charge you 0.23. And the turnover, remember the Royce, what was the turnover? 62%.
A lot.
Just take off the 60, and you'll have the turnover of AVGE in a year.
Just 2%. Holding those stocks for a long time, man. Wow, that's crazy.
So, and, let's look at that other little important number, that the performance versus the index. Now, we don't have 10 years, but we do have 5.
Wow, I've been around.
And it does come in a little bit below the index, but only almost 0.4% below.
Yeah.
Which is 3% below.
Would not surprise me because large and growthy stocks have done better the last few years. So that doesn't surprise me either. Great stuff.
Yeah, so if you have actively managed funds, you're going to get, if you have them in a taxable account, before they distribute that capital, well, you're going to get hit one way or the other. If on an 82% capital gain distribution, you might as well just sell the fund. You might even end up making less. I don't know how that depends on what your cost basis is.
No, yeah. So you'd want to look at that carefully before you do anything. But yes, it's not really a fund that we should own.
It's not
among
a great
others.
fund.
And the list was long. Fund. There was not a short list. There were a lot of funds on that list.
Yeah, but if you use 20% as the cutoff instead of 10, because they said that they had 35 funds that were above 10%.
Yeah.
But if you use 20%, it drops into the teens.
Okay. So then it's not as nearly horrible as Royce Schmid.
No, actually, it's 21 over 20%.
Okay. Yeah. All right. Great stuff. Let's go to the questions. We're getting a lot of questions at talkingrealmoney.com. Love them. Keep them coming. So easy to do.
Tom's had them bound in a lovely leather-bound holder that, because there's so many of them. He takes it home and reads it at night.
Yeah, I read them to my grandkids and stuff. It's fun. Just kidding. Brad writes us from beautiful Bothell, Washington. Now, Brad, I'm going to make an example out of you, so I'm going to apologize in advance. Okay?
Uh-oh.
So here we go.
Brad, I I had nothing to do with this. So when you write a bad comment, Tom is at fault, not Don.
I retired this year at 70, started my Social Security in July. Hey, that's great. I have 3 main retirement accounts I'm trying to clean up and optimize a bit. Social Security income, $41.85. Total portfolio, $744K. $600 in my IRA, $600,000 that is. $96,000 in my Roth, $23K in my brokerage. Current allocations, a balanced 50-50, which includes another $25K in my outside savings account for my emergency funds. Plan to spend $80K per year to live. Plan to use funds in my Roth to cover any long-term care expenses I may have later in my life. So I have two choices for my new allocation I'm interested in using. IRA, which he says $600K focused on safety and growth. Now, safety and growth are two very different things. Yeah. Growth, you have to expose yourself to some risk. Safety, if you said safety to me, I think like CDs or high-yield savings, because anything other than that has some volatility. So, okay, here's where the rub is. Invested in, and I'm 25% BIV, 25% BIL, 15% VYM. He goes through a list of 15 or 20 various exchange traded funds.
Sounds like he has way too many funds.
Well, there's that. But here's the thing, Brad, okay? And then he says, any changes in my holdings suggest. We can't take this up on the show. I'm going to call you. Because this is just too, it's too, we can't do it. I can't ask Don Don never sees the stuff before I ask him. He would have to sit down and go through each one. I don't even know that I know BIL, what that B is in boy, I is in Iger, and L is in Larry. I don't know that I know that one. But there's a lot of them.
I don't know it, so that's why I'm looking it up.
Okay, so.
BIL?
That's what it says. 15%.
Oh, my gosh. It's the spider 1 to 3 month treasury bill.
Oh, okay. All right. So the thing is, we are happy to take these up. We really have to do these on a one-on-one basis.
This is why we offer that free meeting.
Exactly. That's what I was getting to. And it sounds like a pitch, but it's not, because I just can't do these on the show. It's way too much detail to read as a question.
We really, truly, we mean it when we say we want to help everybody.
Yeah,
but
we will help you.
The podcast is just 30 or so minutes long. Yeah. We could take 3 podcasts, 2 at least, to go through some of these questions. These one questions because they're so complex. So we decided a long time ago, and again, some of the advisors do not like it.
No,
and so they don't have to do it.
They don't.
But some advisors really do. They love to just be helpful.
Yeah,
they know it's both good for you and good for them long term.
I love the conversations. Had a nice chat with an 82-year-old Texan yesterday that's a podcast listener. He did close by saying, thanks for your podcast radio show and your consistency over the past decades. I started my retirement totally unfocused, ended up at retirement with a hodgepodge mess with no tax focus at all. You've helped me weed through this mess, taking steps to simplify my old 89 stock portfolio.
Whoa! So he's cut down from 89 to how many? 20?
Oh, no, there's more. There's a lot in there. But while I still have a bunch of rebalancing to do, I feel I'm on the right path. Then he said, I need a nap.
Yeah, I need a nap just hearing
about it.
Brad,
after reading this, I think I do too. So we will be in touch. But
all right. So that question, we're not answering.
The point is, please, if you want that help, then ask us directly, contact us about meeting an advisor rather than writing that in.
And let me just say this again, and I know it sounds like I'm paying lip service to this, but this is absolutely true, okay? We have over 1,800 podcasts now online, okay? You can go back and listen through those. If we lied about this, you know that somebody managed to sneak it in on one of our live radio shows or something, or you'd read it in a review or something. But no, the fact is, we never push you to become a client in these meetings. They're truly designed to do one thing and one thing only, and that is to help you. Why would we do that? Now think about it for a minute. Why would we do that? Because one, we both started just helping people. 1. 2, it's actually really good business. Why is it good business? Because if we do right by you, you're likely, and we know this, we know that you will, you're likely to tell somebody. These guys at Appella, they really treated me well. They're honest. They're not going to lie. and we get clients. So we make money.
Yeah.
See?
It's
Selfish.
karmic. It's the quote. What was the
Not comic.
Not
karmic.
karmic.
Karmic. Yeah.
Don't get me going there. You don't want to head down that path.
Or in Tom's case, as we call it, comic
Non-comic?
sans.
Comics. Even better. What was the one quote? If you help others get what they want, you'll get what you want.
I don't know that quote, but that's a lovely quote.
It's a good quote, yeah. Peter writes us from Stowe, Massachusetts. Hi, Don and Tom. I often do bank and credit card offers and track several blogs about deals. This came into my inbox today. Something about a stock exchange for a higher value. I assume there are some gotchas to this deal. Can you explain what they are? If it's pushed like I assume, it can't be good for a person buying as the site proposing the deal. And they're talking about odd lot tenders, which my kids used to really love because, we go to that drive-through and they get those ones and very popular. But what are they talking about?
I thought maybe you were talking about the retail
Chick-fil-A
store that existed
tenders?
for a while, Odd Lots or whatever.
Odd lot, odd lot tender offer. What the heck?
Yeah, okay, so here's the deal. A lot of companies want to clean up their books. If you own shares in a company, they have to keep track of you. They have to send you out reports. You have to vote. There's a lot of paperwork and there's some cost. Anything less than 100 shares is considered an odd lot. And so what companies are doing is offering deals to buy back your odd lots because it actually, in the long term, saves them money. For example, maybe you got a stock that's trading at $50 a share, and you have 20 shares. Well, the company might offer you $52 or $54 a share to sell them those shares, because then they don't have to keep mailing to you and dealing with you and keeping you on the books. It actually benefits them. And the other thing it does is it also, if they believe in their company, they're doing stock buybacks anyway. It's a way for them to increase their treasury stock and maybe make more money on that stock down the road than they paid you. Mm-hmm. But it's odd lot tenders are pretty. Well, they're not normal, but they're legal. They happen. They don't happen a lot, and they only apply to people who own individual stocks, which is hopefully not the majority of our listeners.
No. So what you're saying is it should be considered.
Oh yeah, if somebody was going to offer me, I'm trying to clean up my portfolio anyway. Okay, which you should be doing.
Yes.
Previous questioner included. What you should be doing, so it's an opportunity for you to get a premium, to not have a commission or a spread when you sell it through your broker, and to get money back in your portfolio that you can put in something that's more efficient, more diversified, a better portion of your plan.
Okay, good answer. From Del Rio, Texas, Jeff writes us, hi, Don, Tom, and Roxy. I would like to add to a question I submitted. My wife and I are both in our mid-30s, both active duty military. Thank you for that. And have about $600,000 saved between 2 Roth IRAs, 2 Roth TSPs, and a taxable brokerage. $220K is invested with Edward Jones between 15 and 20 individual stocks.
Bad idea. Didn't we just mention this?
Yeah, I think we did. My first question is, how do I go about selling those stocks and buy VT and AVUV?
Which account are they in?
That's the Ed Jones 15 to 20 individual stocks.
That's
Doesn't
a
say the
taxable
amount.
account.
Yep. Long-term gain. Should I sell it once at the 15% rate? Yes. I just cleaned that up.
Yeah.
You're young, and I wouldn't, because the longer you wait on that, the worse it could get, by the way.
Either way.
Right.
Either way, by the way.
My
could
second
be the
question
downside,
is,
could be the upside, yeah.
Should I leave Ed Jones?
Yes. There are
He's already
commissions.
moved his IRAs to Schwab. Curious if he should walk or run away from Edward Jones, considering you guys recommend having an advisor for a second. Luke, I love your show.
Yeah.
Ed Jones is not a place to go for an advisor.
No, it's a place to go to buy securities, but you can buy securities generally less expensively at Schwab.
Yeah.
Or Fidelity or Vanguard.
Or if you had to, Robinhood. Where you can
Robinhood.
also bet on the individual pitch in the World Series. I mean, come on. So
Yeah, no.
Yeah.
No. I think the days, it's going to take a while.
Yeah, it will.
But the days of the commissioned brokers, which they now call themselves financial advisors, are dwindling.
Oh, it's going.
They're going away.
It's going down. Yeah. But how long till it's gone?
Oh, it'll take a long time because there are still some travel agents, not one on every corner like there used to be.
True.
Remember the day when literally, I mean, there were travel agents everywhere.
And then
you could walk down the block and go, I can go in and get a ticket right here at the travel agent. Now you have to do it online.
Yeah. So
they don't even want you to call them. Have you called? I called Delta recently for something, and it was like, your average wait time is 2 hours and 12 minutes.
What? Oh, that's it? Just 2 hours and 12 minutes?
I'm going online. That's the idea.
That's crazy. James writes us also from Bothell. Two calls from beautiful Bothell, which is a suburb of Seattle, for those of you outside the greater Pacific Northwest. The last
and then right outside of Bothell is Baby Bothell.
Baby Bothell. Right outside of, there's nothing right outside Bothell.
I'm joking.
Well, Linwood, Lake Forest Park, etc. He says, the last 20 years, I have stayed with blue chip stocks, 10% cash, bonds. Certainly bond funds have been a disaster for the last 15 years. I never have to rebalance. To me, it is timing the market. Over time, an equal return to a 40% bond investment without the bonds. I don't see a question here. I guess the question is, and I looked it up, I looked up the total Vanguard total bond, VTBLX, is it I looked up, you had to go to the mutual fund because BND hasn't been around for 15 years. But it's only made 2.5% for the last 15 years.
2.5% per year.
Per year. Thank you. Yeah. Okay. Pardon me.
Okay. So that's not a disaster.
No, it's not, but the thing is, again,
we had a period of zero rates in there.
I know. Why do you want to own? The question, James, is what's your point of owning? If you just want to make money, well, then put it all in stocks, kid. I mean, because
wait. More. If your goal is just to make money, historically, put all of your money in small cap value stocks.
There you go. Yeah.
Not even blue chips. The heck with that. Just put them all in small cap value.
Chip, yes,
small cap value funds have dramatically outperformed every other investment.
Not even
normal
100 years. 100 years. It's almost 4% more per year to be in small value than in large growth. So that would be the place. So I guess I don't understand what your question is. But bonds, again, should be there for portfolio stability, I guess would be the right word, and to keep you okay, help your emotions when stocks, and I know they never do, go down and go down a lot. So, although I'm reading 1929
why should
right
I
now,
mess with this when I've done so well in blue chip stocks? Could that be it?
I guess, but there's no comparison. They're two completely different securities.
Yeah, but blue chip stocks have done really, really well over the past 2 decades. Really, blue chip U.S. stocks really, really well.
Okay, but give us a definite. That would be large growth.
Large growth,
giant growth.
Large growth over the
blue
past.
Blue chip in today.
Yeah, large. That's large growth. Blue chips. Those are the large growth stocks. And just to put it in perspective, you're talking about that 100-year number from 1926 through 2024. That's 98 years.
Yep.
The total U.S. market has returned right at 10% per year on average.
That's everything.
Everything.
Small
cap value over that same period returned about 13+% per year. 30% more.
Yeah. And when you put that, as we used to do in our talks, when you show what that means in terms of dollars, remember we used to have the stack,
the chart. Yeah,
where up and up and up.
Where we had to change the scale of the chart, or the chart had to go like 4 pages off the top of the screen.
People can that much, that much. So, yeah, blue chip make you feel good. You know the companies, they're reported on a lot, discussed. Not been the best place for your money. So,
but they again.
Well, I'm not saying that just own small cap value.
They have been until this last year.
Yeah, they have. Well, I think still the last 5 U.S. small cap values made more. Remember we touched on that in a recent podcast. So anyway,
the last 5.
I believe I looked it up when we had a discussion about this. So,
because like VOO which is that's the definition of blue chip
yes,
stocks. That's the Vanguard S&P 500 fund, has returned over the past 15 years 14% per year.
Yeah, been pretty dang good. So, and they only go up. I know. So don't own bonds because stocks never go down. Oh, that's right. 2020 and et cetera. So you get the idea. Anyway, that's all the time I have. That's all the questions I have.
We got to go now?
That's it for me. We got to go. Time's up.
All right. If you have questions, send them in at talkingrealmoney.com on the contact form. I like them spoken because then I answer them on the Friday podcasts.
And I like them written because then I get to read them to Don and he never knows what's coming.
And he's going to publish a book of all your questions.
Maybe.
Questions from TRM.
Great idea.
And of course, you can, if you have those really long ones where you have 45 different things in your portfolio, then get a meeting with an advisor. No obligation, no cost. Just go to talkingrealmoney.com, click on Meet an Advisor. In the meantime, you've got some work to do. You've got over 18.
Talking to me?
Yeah.
Oh.
You've got over 1,800 podcasts to listen to, so you'll be better at Talking Real Money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.